Are we witnessing the collapse of one of the world's biggest economies?
Today, we're exploring the implications of China's economic slowdown with insights from renowned finance expert Patrick Boyle.
And stay tuned. You'll gain valuable takeaways in under 10 minutes.
Exactly. Discover how this crisis could reshape global investment strategies.
Welcome to Financial Insights in Minutes, where we deliver key economic updates at lightning speed.
But first, let's hear Patrick's breakdown on the global implications of China's economy collapsing.
Let's dive right in. In today's segment, we're navigating the turbulent waters of China's economy and its ripple effects on global markets.
Joining us is the insightful Patrick Boyle, a finance professor with years of experience in the hedge fund industry and a big YouTube following.
What's at the heart of Patrick's message regarding China's economy?
The core thesis here is that China's economy is experiencing a massive decline, reminiscent of Japan in the late 1980s. This raises concerns about the sustainability of globalization and increasing trade tensions.
How is globalization being affected?
The increasing trade tensions signal an end to globalization as we know it, with China possibly retaliating against tariffs on its electric vehicle exports.
What about the situation with real estate in China?
The collapse of the real estate market is a huge contributor to the slowdown, leading to significant drops in consumer confidence and global ramifications.
What kind of ripple effects should we expect?
China's downturn isn't just a domestic issue. It threatens commodity prices globally, especially for countries that rely on Chinese exports.
How will global markets react to this?
We can expect higher inflation rates as strained supply chains become more pronounced, resulting in increased market volatility.
What does this mean for the future?
We may witness a shift toward regional trade blocs and an increase in protectionist measures. Will long-standing trade norms evolve? That's the million-dollar question.
What predictions does Patrick make regarding this economic climate?
Patrick predicts rising inflation rates as commodity prices soar and global supply chains become tense, drastically affecting consumers.
What about consumer behavior moving forward?
Reduced consumer spending is likely due to rampant job insecurity, leading to significant changes in consumer-facing industries.
What should we take away from our discussion?
Patrick emphasizes that navigating this economic crisis will require global collaboration and strategic thinking to adapt effectively.
And in terms of trade and economics,
it's clear that the need for reevaluating trade relationships and economic strategies is imperative as we face these changes head-on. It's a turning point, indeed.
And hold on, there's more. Up next, we're diving into insights from a market analyst on This Time Is Not Different.
Stay tuned, because you won't want to miss the deep dive into the latest market trends.
Time to navigate through these waters. We're examining extraordinary market signals hinting at potential shifts in interest rates.
Here's the full scoop. The market forecasts the Federal Reserve implementing a historic interest rate cut by a full percentage point. Let's dissect what this signals for the economy ahead.
What's the core thesis that caught everyone's attention today?
A unique market signal indicates a potential cut in interest rates by the Fed, which historically has preceded recessions. Could we be on the verge of an economic downturn?
What makes this signal so historic?
It has never been triggered since 1962. In past occurrences of expected cuts, substantial market declines closely followed. Quite alarming.
What's the connection between these signals and recessions?
Every time the market has expected a rate cut, a recession has closely followed, leading to sharp market declines. It's a troubling pattern.
What's the latest analysis saying regarding the timing?
Historically, signals appeared about 6 months prior to the onset of a recession. Hence, we could be due for a downturn sooner than anticipated.
What's inflation's role in this situation?
Falling inflation may be driving the sudden rate cut expectations, a significant factor in Fed policy decisions.
What predictions are floating about regarding the economy?
Looming rate cuts could lead to significant job losses, possibly triggering a recession sooner rather than later. Significant attention is needed around these signals.
What about the stock market's response?
Expect volatility. Market corrections are likely as investors react to shifting expectations.
In wrapping this up, what should viewers take away?
Markets are showing clear signs of a potential recession based on historic signals. It's time for traders to gear up for the challenges ahead.
But there's more on the horizon. Up next, we have insights from Jeff Snider on new data suggest hiring has never been this bad.
You won't want to miss what Jeff Snider analyzes from Eurodollar University. Stay tuned.
New data sheds light on troubling trends in hiring. Year to date, U.S. employer hiring is down 40% compared to last year.
Indeed, Jeff Snider articulates why this decline is alarming, hinting at a brewing economic storm.
What's the main thrust behind Jeff Snider's analysis?
The essence is clear. As hiring plummets, we edge closer to recession. Hiring is the key indicator, not layoffs. When hiring disappears, job losses inevitably follow.
Let's break down the key elements from Jeff's analysis. First up, those hiring numbers.
Right. This year, hiring has plummeted 40% compared to last year, marking the worst performance in 2 decades. It's like sailing on a sinking ship.
What about retail sales? Are they still reliable indicators?
Absolutely. Retail sales are below 3%, definitely in the danger zone. If these numbers continue to decline, we could face rough economic waters ahead.
Jeff also challenges the misconception that layoffs indicate recession. What's the reality?
Exactly. Layoffs often follow hiring freezes. When hiring ceases, the unemployment rate rises. It's the canary in the coal mine.
What does Jeff predict will occur next?
He anticipates rising unemployment rates. Once hiring halts, layoffs follow, potentially steering us into turbulent economic waters.
Is there light ahead?
Unfortunately, trends suggest ongoing economic weakness. With retail sales struggling, signs of recovery seem far off.
So what should we take away from Jeff's insights?
The bigger picture. Hiring remains the true indicator of economic health. As hiring drops, consumers cut back on spending, and that's bad news.
And don't miss what's next. We'll dive into insights from FX Evolution.
You won't want to miss what I have in store. We'll reveal key insights on what happens next.
Let's dive right into today's hot topic. Will the Federal Reserve cut rates by 25 or 50 basis points?
Here's the scoop. The markets are hovering at key resistance zones, and the stakes couldn't be higher. History might hold the clues.
What's the gist of this video? Why should we be concerned about rate cuts?
The core thesis revolves around critical market conditions leading up to the Federal Reserve's decision. Could this spark market volatility?
Let's break down the synchronization of the markets. What's the significance here?
The NASDAQ, S&P 500, and Russell 2000 are all hitting crucial resistance levels. This could set the stage for market reactions post-announcement.
What does historical context tell us regarding rate cuts?
Historically, rate cuts at all-time highs often result in positive market trends.
What's the sentiment surrounding a soft landing?
Current data indicates strong expectations for a soft landing, but concerns about a hard landing remain.
What should traders anticipate around the Fed's announcement?
Market reactions could be dramatic. Traders should prepare for potential volatility following the rate reveal.
Are there any predictions regarding these rate cuts?
The magnitude of the rate cut will heavily influence market reactions, with volatility likely rising significantly afterward.
How should we prepare for these anticipated market shifts?
Traders need to stay informed and agile. Understanding the Fed's decisions is crucial for navigating the turbulent waters ahead.
But wait, there's more. Up next, we'll explore insights from Darius on a major regime shift at the Federal Reserve.
Stick around because you won't want to miss how this could shape the markets.
Navigating today's currents requires insights from Darius of 42 Macro. He's here to share his forecasts on the Federal Reserve's easing into a regime shift.
Absolutely. Dale's expertise in economic analysis sets the stage for profound insights into how monetary policy will shape asset markets moving forward.
What's the heart of Darius's thesis?
Darius asserts the need for significant rate cuts before next year's second quarter due to persistent inflation concerns. Aiming for a soft landing without triggering a recession is critical.
Let's break down Darius's key points. What's the outlook on those upcoming rate cuts?
Exactly. Darius predicts the Fed will cut rates by 25 to 50 basis points, stressing the importance of starting cuts now for a future economic expansion.
What's the outlook on economic growth?
Darius is optimistic about growth, expecting it to outperform consensus expectations, creating a favorable backdrop for asset markets.
What about inflation trends?
Darius warns inflation is unlikely to sustainably return to the Fed's target unless a recession occurs, advocating for operating in a higher structural inflation environment.
What are the market dynamics to consider?
Darius believes that as the Fed cuts rates, risk assets like equities and crypto should outperform defensive investments, signaling a pivotal shift in market dynamics.
What about international implications?
There's a significant relationship between U.S. easing and global financial stability. Darius emphasizes that excessive easing can impact foreign currencies, leading to broader market repercussions.
What key predictions does Darius make?
Darius predicts the Fed will need to normalize rates urgently, fostering enhanced market confidence that investors are already pricing in.
How will markets likely react to these easing measures?
Darius forecasts a positive shift in risk asset pricing, but warns of potential volatility as investors adjust their expectations.
To sum it all up, what are the big takeaways?
Darius underscores the need for strategic monetary policies harmonizing inflation and growth, and emphasizes sound asset management that can adapt to these changes. It's indeed a time for cautious optimism.
What does Darius suggest regarding asset management?
He advises investors to embrace systematic, trend-following approaches to better capture market shifts while managing risks effectively.
If you're finding these summaries valuable, consider liking and subscribing to stay updated on future insights.
Your support helps us continue providing these valuable analyses, so don't miss out.
What a fascinating discussion we've had today on the intertwining of China's economy and global markets.
Absolutely. Patrick Boyle highlights the looming risk of inflation and shifting trade dynamics due to China's decline.
And Jeff Snider warns us that a downturn in hiring could mean a recession is on the way.
Not to forget Darius Dale's insights on how the Federal Reserve's actions could potentially stabilize or further disrupt markets.
Each expert shared valuable perspectives, yet they had differing views on the Fed's future impact.
Indeed, it's clear that these are lively and nuanced discussions that every investor should stay tuned into.
If you found these insights valuable, don't forget to like and subscribe for more expert analyses.
And check out our other content for continued economic education and market awareness.